All right, we're officially recording now. So, welcome, guys. Thank you for being here. My name's Brandon Cunningham. Some of you know that, some of you might be a new face, new name, because we've been promoting this in a lot of different places, trying to reach as many people as we can, because I believe we have entered a really, really difficult place for many financially. And ironically, I think there's more opportunity right now than there ever has been. Uh, and that has always been the case, guys. Where there's the most struggle, I'm talking human history. Where there's the most struggle, there's equal opportunity. That's how it works. You just got to be in the right conversations. And that's what tonight's about. So I have got Mr. Wayne Barber here with us tonight. Wayne is someone I've known for a decade, and kind of re-entered my life because I try to stay connected to people. We went and had lunch, we laughed, and we started talking money. And I found out at that meeting he had an equal passion for that I'd have, and that is what I've already stated: making your money work harder than you do. And so I'm excited he's here. He's got like let me put this disclaimer out. I can't give you financial advice because I don't hold one license, but I can tell you what I do, right? And what my thinking is, my philosophy. And Wayne, let me just tell you this: Wayne works with highly ultra successful wealthy people. That is the majority of his clientele. In fact, Wayne, a couple of weeks ago, the last call I did with Wayne, Wayne introduced me to a guy, and the guy basically said, "I only work with people that are worth $40 million." And I was like, "All right, I'm on the right call. Thank you, Wayne. I'm glad you connected me to this one." So, Wayne, say something. Let them see your face. Say hello. Give them a little bit of your background, kind of your certifications, and he calls himself a financial architect, and he is. So say hello to everybody, Wayne.
Hello, everyone. Wayne here in sunny Florida. I got my little beach scene in the back, so you guys can join me, relaxing. Uh, Thinking about this might be a place you want to come visit. I know some of you guys were down here just recently for the Castaway event, so some of the stuff you might hear may be redundant, but I'll try to answer whatever questions I can. Um, to answer Brandon's questions, yeah, I'm fully licensed, both on investments and insurance. I have pretty much, the top licenses you can get from an investment standpoint. Um, I do work with a plethora of people. I don't want to give you guys the impression that, you have to have $40 million to work with me. That's not the case at all. I do work with a lot of people across all different backgrounds and socioeconomic backgrounds. For me, this is a calling for me, more than it is a profession. So my heart is to help people not be in bondage of money. So a lot of times it's simple. It's just about education. People just don't know what they don't know, or their background or their psychology of money is maybe just off or twisted or broken or just non-existent. And so I try to help educate. So my process specifically is rooted in education. My goal for all my clients is to make sure that I increase your financial IQ on some level. Some of you guys know more than others, and so that's fine. I just kind of meet you where you're at, and we go from there. So if you're like, I don't know anything about money, I don't even know the difference between a stock and a bond, okay, we'll have a different conversation. Or if you're more savvy, like Brandon, he's like, yeah, I know all that stuff. Tell me what the best places is to put money. Tell me a safe place. And I'm also looking at risky stuff, whatever. Like, I just need someone to help me manage and then maybe even give me a tool that I can use, because I got so many other things going on. I don't really have time to do this, whatever. So help me get organized.
Right on.
I
So
can do
guys,
that too.
so Wayne can give you advice. He's the certified guy. I'm just going to entertain you. I'll be investment entertainment. He can give you the advice. So here's what we're going to talk about tonight, guys. I know a lot of you are ready to put your money to work. All right. So we're going to focus our conversations tonight on investments, because when you start working with a team, it's a big daunting conversation, because it's not just about investing in order to really accomplish what you want to accomplish. There's so many things, asset protection, like insurance, there's so much. Okay. But we're going to stick in just the investment lane. And I asked Wayne to have a conversation with us tonight. And what we're going to do is Wayne and I'll have a conversation for a few minutes here, and then we're going to open this up to Q&A. I'm going to want you guys to raise your digital hand, and I'll kind of moderate and see if we can get a few personal questions that maybe you guys have outside of investments. Maybe it's inside of investments. Wayne will obviously answer what he can answer. He's not a fortune teller. If he was, I wouldn't work with him anyway. So anyway, here's the deal. There are, in my opinion, 3 levels of risk with investments, right? There's mild to no risk. There's mild to medium risk, and then there's high risk. All right. And I kind of want to walk through this with you guys, and let Wayne and I have a conversation. Wayne can define what he thinks is low, medium, and high. And I'll talk about some of my low, mediums, and high. And let's just start with what I've done and Wayne knows about. So in my opinion, guys, there are low risk investments. To me, I've gone into the insurance world, right? There are insurance vehicles that looks and sounds and smells like insurance because it's actually labeled and titled insurance. But in reality, it's a steady performing 5-6% return and has done it for 100 years. Okay. If something has performed for 100 years, the same, that's pretty much no risk to me, right? Medium risk is things that have got a pretty good track record, but there is no certainty, right? So for me, that enters into the stock world. You start purchasing stock. Now, even within the stock world, you're buying stocks of company or shares of companies. No one has the crystal ball. No one knows exactly what's going to happen with a company, but there are levels. There's some companies that have been around for a long time and are very predictable, and probably are not going to go away because they just have so much cash. I'll let Wayne maybe define who some of those people are. And then you have your high risk. And as Wayne and I will talk about, you can have medium to high risk with stock or real estate. In my opinion, real estate is in that mid-level risk area, for a lot of reasons. But if you buy at the wrong time in the wrong place, high risk, right? Like if I was you, I wouldn't be going by any commercial real estate right now. I wouldn't be buying commercial high rises right now because the majority of the world has left those high rises. They're not there. Just if you don't believe me, go do some investigation on downtown San Francisco and just ask a few questions, and you'll soon figure out it's because no one's in those commercial buildings anymore. And high risk is venture capital, where you're starting a business or you're investing in a business, and like even in the world now of crypto. And I'll let you guys know, I invest in all 3. When I mean all 3, low risk, mid risk, and high risk. Now, every one of us has our own risk tolerance. And that's also what I want to talk to you guys tonight, because some people may think that crypto is or venture, let's stay with crypto, just crazy. It's like this far out wild thing. Some of you others may be kind of into it and be like, hey, no, I think like the world of, decentralization and a global currency might be a real thing. Like, everybody kind of has their own definition there. So Wayne, I want to kick this over to you. Let's start with low risk. If someone comes to you and says, hey, listen, man, I've got 10 grand and I don't want to lose it. I'm not looking to hit the ball out of the park, home run. What kind of investments or what kind of vehicles do you start to talk about?
Yeah, it's a good question. And I do get that a lot. And you could look at this a couple different angles. One, I want to understand first, do you have any biases towards any financial products or strategies? Because people can sometimes say, well, I want to do this, but I don't want to put money in this vehicle. Well, that might be the best thing that meets all your goals, but because you read something or heard something negative about it, you're basically self-sabotaging your ability to accomplish your goals. So to your point,
Can I
Brandon,
interrupt you? I need this Wayne. I need you to let's do like it's our own conversation. Wayne and I have this great relationship where Wayne gives me all the details and I keep interrupting him. And I'm so glad that he's patient with me. So I'm going to interrupt you because you just said something huge.
okay.
I think a big problem with people is they are watching so much media, and the media that they're watching and reading is really affecting their head and their emotions. And so can you talk to that a little bit when you're like, where do you go for source? Like what is your source for knowing what's real and what's not real in the banking world and investment world?
Yeah, I actually go to a lot of the sources. I'll go to my asset managers, my portfolio managers. I get regular monthly and quarterly updates from what's going on in the market. If something big happens in the banking world, probably within 24 hours or 48 hours, I'm going to get some message from my broker dealer saying, hey, here's what's going on. Here's how you need to, here's what you need to understand. So as you have conversations with clients, so I get a lot thrown at me. I try to sift through it. I'll also go online because I want to know where my clients are going to get information. So I just go up there every now and then to see what's out there. I've heard all the stuff that Dave Ramsey, Susie Orman. I taught financial peace. I've gone through it. So I know about all of that stuff. There's a lot of self-proclaimed gurus out there, but you just got to understand, think logically. When you go to get information, specifically professional information, who do you go to? You go to people who are credentialed, that that have the necessary licenses and are legally able to give you advice. So you wouldn't go to a mechanic if you were looking for information on a health ailment, right? They're just not qualified. Nor would you probably go to someone that's not licensed to practice medicine if you're talking about something where you need surgery. So you just got to be careful who you listen to. I'm not suggesting nor implying that all licensed professionals will do the right thing. That's really some discernment you'll have to use, getting to know the person, getting to understand how they operate. Referrals are always good. I mean, what Brandon's doing right now, opening up his professionals to you guys is not normal. So, you guys are really in a good situation to get access to the people that he works with. And that's not to toot my horn. That's just showing the generosity and benevolence of the Cunninghams. Great people. They believe in the rising tide raises all ships and sharing the wealth. So, but you just have to be smart about who you talk to. I would also say educate yourself. Don't rely solely on what someone tells you, but do the research. We live in an age where we are drowning in information, but yet we're starving for insight. And you got to know how to cut through all the noise, because it all can start to sound the same. And there's a lot of just product pushers out there. You need to find someone that literally is that has the heart to educate you. Like, there's no stupid questions. There's no judgment zone. Are they willing to help you and your family get to where you're trying to accomplish financially? So there's a lot of sources out there. Word of mouth is always good. If you see someone that's doing something well and they're having success, ask who they're using. Ask why they like them. What is it about them that you feel like is helping you get to where you want to go? Referrals are 100% of my practice comes from word of mouth. And so, it's just important that you take serious who you get advice from, because it can literally make or break your financial future.
Yeah.
And so
Be careful, guys. Be careful with the YouTube guys. Be careful with the guys that are using Instagram and Facebook to drive you to their YouTube courses. Be careful. But they have it. I'm saying they're not good guys as far as what they're telling. Just be careful. So, Wayne, outline what you think is low risk type investments. Like, if someone comes to you, like I said, 10 grand, and I want it low risk. What are you thinking for them? And I know there's all these, sideline questions, a million questions, but do you start thinking insurance vehicles? Do you start thinking something else?
I don't immediately start thinking insurance vehicles, because really the insurance vehicles that I use for really safe money growth, kind of like what we're doing with you, really is highly dependent on your cash flow and ability to continually fund that and support it. If you can, it's phenomenal. I use it for college planning. I use it for business planning. I use it for everything, and it's a great way to build tax-free wealth, specifically for wealthy people that can't do what the government has allowed us to build tax-free wealth in a Roth or some other vehicles. So it's not my default, because I do have to have some other questions, but basic stuff, safe, you guys know this, savings accounts that has some form of reasonable yield. Now the interest rates are higher. You got accounts out there that'll yield somewhere upwards of 4%. But just understand, when you put your money in those vehicles, you're not expecting to knock it out of the park. It's literally just steady Eddie. You put it 10,000 in there, you're going to earn 4%. That's not a lot. So it just really depends on what your goal is. If it's just to be safe, most savings accounts are going to be safe, right?
Here's something I want to throw out there for you guys too, something important for you to know. Your age has a lot to do with what you should be investing in. What I mean by that is, the younger you are, the more risk you can take, because I'm going to shoot straight. You got time to make up for your mistakes. If you're in your 20s and you're investing and you invest wrong, you got a lot of years to fix it. If you're in your 50s and 60s and you invest wrong, you just don't have a lot of, you missed 3 decades, right? The 20-year-old's got 3 decades, right? And so the older you get, the less risk you can take, unless you're sitting on a pile of cash already, right? And that's the ultimate game. That's phase 3. If you haven't seen my 3 phases, guys, that's phase 3. When you're in phase 3, man, you can not only swing for the fence, you can do it blindfolded. And I do it. And Wayne makes fun of me sometimes, because I do. I blindfold and swing for the fence on some of those bad boys, right? Yeah. And so anyway, your age has a lot to do with this. So all right, well, let's step into medium type stuff. Like if someone's like, no, I'm not good with 4%. I'd like to get to 8, 10, 12. What are you talking for them?
Well, in that range, we're probably looking at some type of portfolio. Like we can put together some type of diversified portfolio, and depending upon how much risk you want to take, and how concentrated your investment wants to be, we could put together something that's customized to you, and depending upon what your amount of investable assets are, would determine what other levels of services we can provide that's more custom. So, the nice thing about stock, investing in the stock market, is that you can diversify to the nth degree, to the point where you're basically taking very little risk, because you're globally diversified and your asset allocation is more tilted towards fixed income versus securities. And with this whole topic of risk, there's really two dynamics to that. There's your ability to take risk, and then there's your willingness to take risk. You may have the ability, but not willing. You may be willing, but really don't have the ability. What I mean by ability is financial ability. You may be a risk taker, but if that risk goes south and you're financially destroyed, then you really don't have the ability to take that level of risk. Or you're just not the type of person to take a lot of risk. You could have all the liquidity in the world. You could have plenty of money to do so, but you just are not comfortable. And either one is okay. You just have to know the difference. And there's balance. You need to have some financial balance. So when we talk about risk, specifically, how much of your money should you take? You put at risk. Ask yourself this question: if I had $1, how much of that would I put at risk, and how much of that would I want to be safe? Understanding that the safer you are, the lower the returns are on average, and the more risky you are, the higher the returns are. You've all heard the phrase, no risk, no reward, right? That's kind of the term, or the phrase. But if you're a moderate risk taker, a very skilled, put together portfolio would probably work for you. And depending upon your age, we would allocate that accordingly. And then if you have a higher risk tolerance, then I'm going to ask you some additional questions to see if that's a suitable risk for you to take. Because one, I don't want to get in trouble. Because if I put somebody that should not be in a certain level of risk and they're a certain age and it goes south, I could actually be held liable. So I'm very sensitive to people that are older wanting to take a lot of risk, even if they have the willingness or ability to do it. We just want to make sure financially that you would be able to sustain that level of risk should something go wrong.
Let me just because of the time stake, next time we do this with Wayne, we'll give more time slotted for this. I want to open it up for Q&A. Listen, I already told you what high risk is. In my opinion, it's starting businesses, being a venture capitalist. Your friend needs 30 grand to start a business. That's high risk. But could be high rewards too, depending on the situation. But I'm going to open it up for Q&A. I'm going to watch to see if any digital hands go up, because we got just a couple minutes here. And if not, while I'm waiting, Wayne, will you elaborate a little bit, see if we get some hands up here? I'm not a fan of 401ks and those traditional type things. And here's why, guys. When you go into one of those, it's diversifying your investment now so that you don't pay tax now, right? So that you can pay it later. Like that's what that program is, right? Put it in, you're not going to pay taxes on what you put in there now, but you'll pay when you pull it out. The problem with 401s, and the other thing is a lot of these investments are based on the stock market. So depending on what you think the stock market's going to do, but the problem is what you're saying is, I want to make less money in the future when I retire. Like I want to be poorer when I retire, or making less money when I retire than now. So I'll pay less taxes when I retire because I'll be making less money. I'm not signing up for that, guys. Like that is not what I do. Like I had a 401 just because we were trying to stash some money away and I stopped it. Like I don't play that game. So Wayne, we've got a hand up. Let's go to Tom. Tom, go ahead and ask your question, and just know I've got a hard stop in 6 minutes.
You're on mute, Tom.
Let me unmute. There you go.
Tom.
Got it. Can you hear me now?
Yep. Go ahead, Tom.
Okay, great. First of all, I want to thank you for introducing us to Wayne back at Castaways, because we started working with Wayne and we're very, very happy. Wayne, I have two questions. Sure. One is, first, your opinion of investing in gold and silver or crypto. And then secondly, there's a lot of opinions both ways on paying off your mortgage and whether or not, if you have the opportunity to do that or not to do that. I'm interested in your opinion.
Yeah, so good question. So as far as my view on precious metals, I like precious metals personally. A lot of advisors don't. But I don't like precious metals for the investment aspect of it. They're a hedge in my mind, right? They protect your wealth from the erosion of the dollar. So I like it from that standpoint. I don't recommend you allocate a lot of assets to that, maybe 5% of your portfolio in precious metals. So that's surface level answer for that. As far as a mortgage, if someone asks me, should I pay off my mortgage? My first question is why? And it depends on, what stage of life you're in. If it frees up a substantial amount of cash flow for you to do so, great. If not, why do you want to pay it off? Especially if you don't need to pay it off. A lot of people just feel like, I don't want any debt. Okay, then pay it off. But does it really make sense to do so? It gives you some write-offs. It gives you some other tax advantages. You just need to have a good reason why to pay it off. Otherwise, build some assets and let your assets pay down your mortgage. Don't use up your assets to, don't take the liquidity for your discretionary income to pay your mortgage off. That's my thoughts on that.
Yeah, and that question, Tom, we could go at for like 30 minutes, but I hope that Yeah, we're going to give this more time next time because I'm enjoying this. Thank you, Wayne, for being on. Let's go to it says Anne Marie, but I know it's not Anne Marie. Go. Let's go. Let me unmute over there. There we go.
Oh,
there you go.
All right, here we go. Hey, Wayne, thanks, Brandon. Quick question. So Brandon touched on the 401k trap that I got in when I moved from one job to another, right? I had to roll that over into an IRA, but it's still the 401k type. Would you recommend, if I can take that money out and put it into a regular Roth and pay the taxes now, or a percentage of, work on getting that out?
Yes. If I'm understanding your question, you've got a 401k, you've rolled it over into your own individual IRA.
Correct.
And you're wanting to take the tax hit and put it into a Roth.
Yes.
Yeah, I would absolutely recommend it. I'm a huge fan of tax-free wealth, guys. And just think about this as a concept, because I know we don't have a lot of time. The more tax-free wealth on your balance sheet, the more powerful your financial picture is, because you now have a bucket of money that is disconnected from Uncle Sam. So now you don't care if they increase the tax rate to 50% or what it was back in the 80s or the 70s, right? Because you've got wealth that you can draw upon that Uncle Sam can't touch. So anytime you can build tax-free wealth, I'm a huge fan of it. Problem is with the Roth, they limit you. So unless you're over 50, you can do the catch-up provision, but otherwise you can only put like 6,000 to 7,000 in a Roth. That's why you need to know other strategies that you can leverage to build tax-free wealth. One of those happens to be insurance, right? But again, if you listen to the wrong people, they'll tell you insurance is bad. Well, you think about what is the whole point of insurance? It's to mitigate risk. So why wouldn't I put my money in something that's going to reduce or mitigate my risk? That just makes a lot of sense. Not to mention all the other benefits that we don't have time to get into today, but you just got to think logically, and you can logically think your way through like, oh, that makes a lot of sense. I don't really focus on what a product is more than I focus on what does a product do? What will it do for me in my financial situation? Would I want that type of asset in my financial landscape? Yeah, that sounds good. Okay, then what it is irrelevant. Is it insurance? Is it investments? Is it annuity? It doesn't matter. What does it do for me? It satisfies my risk tolerance in this area. Then I got my money in other areas that satisfies my risk tolerance in that area. So that's why it's important to just be agnostic to the financial product. They're just tools. That's all they are, right? Some of them better than others, but they're just tools. And as you build the house, you wouldn't tell your general contractor that, hey, I want you to build my dream house, but you can't use this miter saw. He look at you crazy like, do you want me to build it or do you want to build it? Like, that's why, you just got to be careful that you don't self-sabotage because you heard some financial entertainer that told you what you shouldn't do, and they don't even have a license to give you that advice. So you just got to be careful what you listen to. But to your point, absolutely. If you can build some tax-free wealth, take the tax hit. We do that all the time. We call it backdoor Roth conversions, where we'll take a qualified or IRA and we'll take the tax hit, maybe do some tax bracket management and dump that money into a tax-free vehicle.
Awesome stuff, guys. Thank you all for being on. Thank you, Wayne. You're amazing. You really are. You're a huge value to us personally, and we are making our personal professional team available. Wayne, Brian Gunderson is going to do one of these for us. Brian's in. So nice. I'm really excited about that. And just so you guys know, the insurance thing, we've talked about this before. I've talked about the book. You guys have bought the book, Cash Flow. I've got it somewhere around here. That's the insurance we're talking about, participating whole life. Wayne said you got to have enough money to pay, and it's true. But my son, who's 18 years old, is set up on one of these plans, and my son doesn't make a lot of money. Okay, so my son has limited cash flow, but he has enough to make sure that premium's covered. So you don't have to be like this mega wealthy person to take advantage of what Wayne can set you guys up on. But ultimately what we're doing is making you your own bank. Like, you need to have your own bank and not have to go to a bank, and we can do that. Wayne can do that. So Wayne, we'll do this again. Thank you guys for being on. Listen, if you really want this thing to explode, like we all should, when I mean this thing, like what we're doing here, and I say the thing, right, is in educating people. Have more conversations with your friends about this. Share with them your thoughts. Share with them where you're getting some information. Share with them these groups, because the bigger we can spread this network, the more people that we can pull in, the more professionals we can pull in, to give you guys real education, not marketed social media bombarded education, but real education. And so thank you guys for being on. We are 1 minute late for the next Zoom or broadcast, but we'll see you guys. Have a great night.